Welcome to the Big O Money Show. Thanks so much for tuning in this morning or whenever you're listening, because we're streaming on Spotify and Apple and Google and all the stream yards, right? Is that what they all are? Streaming services.
Yes.
Yeah, so you're listening to the Big O Money Show, Premier Advisory Group. Bill Altman here. Tony Shore is back with us this week. I hope everybody's having a wonderful warm up to the week. We had a warm up. We're heading into a little bit warmer temps, kind of nearing the end of summer. It's exciting. I'm pumped about it. I love it. I love the change of season. We talked a little bit about that with Andrew last show, and we're here. So, and what a beautiful time. Our condolences certainly go out to Charlie Kirk.
Yeah.
Just senseless violence, senseless. Unbelievable. And somebody that really tried to offer a platform for both sides at universities and allowing kids to get out or young adults to get out and actually speak. And it seems like anytime that happens or anytime somebody disagrees with somebody, whether it's right or left, there's some type of senseless act of violence. And not always, of course. But too often, and this was too often, leaving behind a young family, married.
Oh, two little kids.
Yep, real sad. So, a judgment day for that individual will happen, I'm sure.
Yes.
And, in one way, shape, or form.
Oh, yeah.
Right.
Yep.
Markets are looking strong. We are seeing some data come back that isn't so hot. It's not the hottest type of data that you want as for with a growing economy, but that's okay. We talked about labor last week.
Yeah.
We talked about the Fed wanting to slow things down, and the chance that Andrew told us the money line on interest rates is 97% now. Now you can bet on. You can go to Vegas and bet on interest rates. Wow,
there's a line on interest rates. In other words, you can bet whether they'll go up or down.
You can bet on anything, Tony.
I guess so.
Yeah.
Yeah, the whole betting craze has gotten out of hand. You can bet on anything. It's
on
crazy. Yeah.
That's right. And our Nebraska Huskers. Whoa, holy smokes, right? Jeez.
Yeah.
But we're seeing a lot going on. Health insurance costs, talking a little bit about that. They say they're going to increase about 9.5%. The premiums are going to increase 9.5% next year.
Wow.
That's a chunk year over year. I mean, that's inflation. They said the average family's health insurance cost right around $25,000 a year.
Yikes.
Is that nuts? 25 grand.
Yeah.
Yeah.
Yeah, that's terrible. I mean, healthcare has gotten out of control in this country, and I don't know what we can do about it. And I'm not saying other countries have the answer either. That's for sure. I mean, there's issues all over the place, but wow, the costs have gotten out of control, and I don't know how they can rein them in. But I hope that smarter minds than mine hopefully are working to figure this thing out or make some changes.
Yeah, and efficiencies.
Yeah.
We don't want to get to the point where we cannot receive health care. We don't want to get to in 6 to 9 months before something is able to happen. Now, I will tell you right here in Omaha, Nebraska, if you particular surgeries, like they wanted to do what do they call it? I got a diverted nose thing or something like that. I don't know. I forget exactly the name of it. But they can go in and it's like a big surgery. And she's like, well, I'm available like next fall.
Oh, next fall. That's over a year away.
Right. Yeah. And so
no.
And this was like a year ago and I ended up doing something different. I didn't want to.
Sure.
Yeah. I didn't want to deal with a major surgery is really what it was. So the waiting the year thing, for me, it wasn't terrible. And because it wasn't like dire need.
Right.
And I'm sure like if there's dire need or something happens or there's a car accident and they have to go up into that nose or whatever, that person's getting seen right away.
Yeah.
We don't want to get to a point in the US where that's not able to happen and that person is suffering for a long time because then that leads to death, right? Or another illness. So we got to get people taken care of. But yeah, just efficiencies. And Tony, I'm with you. I don't know. I don't know how to improve it. I think there's probably a substantial overbilling, between providers and insurance companies. Why is the cash price so much different than the insurance price? Insurance companies are going to charge, unless they're a nonprofit, and the nonprofits. I have Blue Cross; they're a nonprofit. My premiums are the average. I
Right.
pay about $25,000 a year in insurance premiums for my family of 5.
Wow.
Yeah, it's chunk.
Yeah.
And
That's
and you think about employers, and then if money could be saved on that side of it, how could you pump that money into something else? I mean, that it's an outflow, it's already going, right?
yeah.
How can I increase the salary? How can we make programs like the fitness and nutrition and start employing some of those, or get a credits back, right? And then I'm going to provide gym membership, and I'm going to provide a stipend for nutrition, or whatever.
Be more proactive on the proactive end to eliminate healthcare
Right.
costs down
And,
the road. I think
yeah,
that's really smart.
and then we get a credit back, and
Yeah.
then less reliance on the actual medical industry.
Right.
Less reliance then on the insurance
It's
companies
a
that are
great
paying that
idea.
bill.
Yeah.
Little things like that, but just, and then really employing them, really coming to light with that. I think that would be really cool. And then I think also clients can get on board with that. I mean, look at Medicare, for instance, what Medicare has done with providing, whether it was the Silver Sneakers program, and different companies call it different things, but we can have access to a gym, or the out-of-pocket, over-the-counter credits that they give you every month or every quarter, where you can either go use their card, or you punch in your number, or whatever the situation, or you order out of it. I mean, you used to be able to order out of a magazine.
Right.
But you can get these different things, nutritional supplements, vitamins, whatever it takes, on the health insurance company's dime. And if you're taking care of yourself, then they get to take less care of you, right? They
Yeah.
don't have to constantly be reaching into their pocket because you're in better health. I'm sure, Tony, there's a positive correlation between being healthy and going to the gym. I would have to imagine.
Oh, for sure.
Yeah.
I mean, yeah, without a doubt.
Yeah,
Right.
and then eating right, and less processed foods, and
Yeah.
cooking, and just taking the vitamins and supplements, and drinking your green tea. I mean, this is all obvious. This isn't something that I'm, here, Dr. Altman here coming at you hot on a Sunday morning.
Well, I'm not a doctor, but I play one on the radio
Do you?
sometimes, Bill.
Oh,
Yeah. Oh, yeah.
yes.
Dr.
Okay.
Tony Shore. But you're right. And obviously, people who watch our videos know this. I struggle with processed foods, and my diet is where I need to work at it. I do walk and try to exercise regularly, and that's good. That's helped. A
Mhm.
lot of water. And these are common sense things, but yet Americans still eat primarily processed foods. And so that's a systemic problem, just like
It's easy.
the healthcare industry and insurance. I mean, my son Adam does auditing for the headquarters for a large chain of pharmacies that are in grocery stores
Sure.
in the Midwest, mainly in Minnesota. And he works for corporate, which is in our hometown of Stillwater. And he said, he has to deal with the insurance, the paperwork for the insurance companies, covering what they're going to cover for these prescriptions, and making sure that between the drug companies, the insurance companies, and their pharmacies, everything's going good. And he just says the more he learns about how health insurance works and versus what's paid for, what's not, the costs involved. And he's worked a bit in the medical field too. And it's just, it needs reformed.
Oh yeah, big time. Yeah. And hopefully, it gets there, but it seems to be going the other way really quick, like snowballing the other way really quick. We've seen this year, we can't really talk too much about it, but I have seen a glimpse in the Medicare world. There are a lot of changes in Medicare this year. Kind of like holy crap changes. Like certain companies, they don't want new business. They would like to retain what they can, but they do not want a new client.
Wow.
Yeah, that's where it's going. We're seeing
That's
that.
interesting.
And it comes down to a cost.
Yeah.
Okay, there's a cost to do business, and at some point, You just go into a retention mode. Same thing we see with insurance companies, for whether it's life insurance companies or whether it's annuity companies, which are life insurance companies, really.
Sure.
And they go, and all of a sudden it's like, well, geez, they used to have just tremendous rates, great rates. Why don't they have great rates anymore? Well, they don't need to. Well, they're now in a money management world. They've accumulated,
Right.
the billions of dollars that are there under their management in their general account. And now we're at a phase where, of course, we want to retain that, but we want to grow that. We're investing that general account money, right?
Yeah.
And of course, by guidelines, we have to keep certain reserves. But why don't we have the 7% rate with them anymore? Now it's a 3% rate. Well, that's why they don't need it. They don't want it. If they
Right.
want the business, they'll buy it.
And it got so competitive. There was this great window for a number of years, as you know, Bill, and
Sure.
I know this because of you and the business you do, where there was such competition between the insurance companies to get this annuity business.
Right.
With all the baby boomers retiring, they said, we want that business. So they offered very competitive rates,
Right.
eliminated no fees. Some of them had no fees. They had complete downside protection. They had more upside, and they had higher rates that they would pay out. So
Right.
all of these things, it got so competitive that it was great, but that bubble has kind of burst, and now they got all their clients, and they're like, we don't want to take in any more new clients, at least not at those rates.
Or we'll see companies come out of the woodwork. All of a sudden it's a good company, they've been around for a long time, but just never really played in that industry. They have plenty of reserves. They can do it.
Sure.
They're ready to go, because all they're looking for, they're the underwriter. If ABC Insurance Company, they're just the ones that are underwriting it. They're the ones
Right.
holding the risk, they're creating the reserves, doing the servicing, all that kind of jazz. And sometimes they don't even do the servicing anymore. They sub that out.
Right.
It's almost like a Fannie Freddie type situation on a mortgage.
Yeah.
But then you have a designer of products. So then you have a company that would, say, here's this great design. This is what we think and how it can happen. And this is what your spread is going to be, Mr. Insurance Company. This is how much commission can be paid on the product. This is how much upside for your client. Here's the design. We just need somebody to now underwrite it for us. Who's going to be that person? Who wants to be it? And they put it on a limited distribution model a lot of times. So we've seen more and more of that throughout the years. And this isn't anything new, but I think I first started seeing this limited distribution model back in like 2004, I believe, right in that 4 or 5 range.
Mm-hmm.
Where now we're seeing it on a regular basis, where
Sure.
it's not just open to everybody. You have to go through another company. You can't go
Yep.
direct.
Yeah.
I cannot go to one of these companies myself and say, hey, I would like to offer your product. They're going to say, well, you need to be contracted through what they call an upline, through a Gradient insurance brokerage or one of the other fellers.
Yeah.
Other fellers in town.
Yeah. Sure.
You like that?
Sure. Yeah. But
Down south.
yeah,
Let's
it
call
is. It's really changed, and some for the good. That competition really helped, our listeners out there, if they were doing financial planning, and they helped a lot of your clients because you got them into these great options, like the buffered index portfolios. But once so much business gets in there, then you kind of see those change. And so they're like, well, we don't have to, we opened the floodgates to get clients in, but now we're closing them a little bit. We're going to raise the, interest rates have been higher. So we're going to lower what we pay out because we think the Fed's going to lower it. It's kind of a preemptive deal too.
Right.
Everybody says, even though inflation might be ticking up a hair, that the Fed will now lower rates. So we'll see what happens there.
Yeah, and I'll tell anybody, listening to the show right now, if you have money that's sitting in a checking or a savings account or a money market and it's not doing really well, like 3+% for you, it's safe money, then you need to come and talk to me so we can figure out a way to better position that money.
Sure.
Keep it safe, keep it liquid, keep everything, all the guarantees, all that kind of fun stuff, because those rates are out there. And Tony, I see so often, so same with Andrew and Jake and everybody here, we constantly are seeing statements where the checking account is not paying anything. The money market's not paying anything. Who's winning on that deal? The bank all day long is winning on that deal.
Yeah.
And so how can we, and it doesn't have to be put inside an annuity. It can be put inside a short-term bond fund. It can be put inside different money market options that you have. It can go inside an annuity if you want to, if you're comfortable with tying it up for a year or 2 years, right? Kind of
Right.
like a CD, right? There,
Right.
whereas money market and your checking accounts or your savings accounts, those are liquid, right? No fees to get out for the most part.
Right.
And then you get into your CDs and your annuities, and they might
Your
be,
MIGAs,
yeah,
right?
a 1 year or a 2 year or whatever it might be. And
Yeah, 2 or 3-year
typically,
MIGA, you can get one paying
I saw
above,
like a 5.65
yeah, above,
recently.
well above CD rates or any bank type interest rates right now. Yeah.
565 on a 2 year guarantee, fully insured.
Wow. Yeah.
Jeez.
Yeah, and from highly rated companies. So there's
Highly
still
rated
some
companies, yeah,
competition there. And,
right.
I would strike while that iron's hot because the interest rates may go down and then you're going to stop seeing that. So you
Right.
need to, it's a good time to get into that.
And some of those, I do want to make sure I clarify here. Is some of those, when I say fully insured by the issuing company, so some of that on the annuity side, or the life insurance company side, you're insured by the company. So it's based on them. If something happens to the company, Nationwide Financial or Athene or whoever it might be, that's the company that's really underwriting that debt. Now the states do have guarantee funds that are there, but it's not FDIC. So I do want to say that.
Right.
But those options are out there. No, have we seen defaults? No, we haven't seen defaults. From 1999 through now, we're sitting roughly at 25, 26 years that I've been involved in this business, and I can't remember of a single default on one of those type of products.
Right.
And I mean, that's how heavy the reserves are. And
Right,
that's
and
what we
most
look
they
for.
have to be insured as well, usually through, the state or some type of I insurance and laws,
Right.
and it's about the same as a bank. A bank will insure your money up to $250,000, and your insurance company, you can insure up to 250. They're insured up to $250,000 for
State,
most
state by state.
by
And
state. Yeah,
it's going to vary. I think Nebraska's that
yeah,
250 mark on that
yeah.
life and annuity side if something were to happen. But the reserves have to be so strong at all times that it typically doesn't get into that point. If it does get somewhere, it gets into like a receivership situation where the
Then a
state
bigger
steps in.
company will come in and take it
Yeah,
over and
exactly.
yeah, it's
Yeah,
based on the claims paying ability of the issuing insurance company, but that's good news because you work with only the top rated
right.
companies, and they're always able to, because if they can't, then they get taken over by a bigger company and who
Right.
honors that.
I
So
mean, we get to build portfolios now, Tony, that have tons of safety built into these portfolios, whether we're using an annuity or we're not using an annuity or whatever we're doing. Our
uh-huh.
buffered index portfolios, where you can get 100% principal protection and good upside with your traditional S&P 500, Dow Jones, Nasdaq type of markets. Nothing crazy, nothing goofy. You can get designed income that are paying 7-8% plus on their coupon payments, with tons of principal protection on the downside. Then we still have our tried and true S&P 500 type of portfolios,
Yeah.
or our dividend portfolios. And so we can couple that with like our fixed income total return, where you're still, I mean, heck, I think this year I just looked at an account because I was having a review with this gentleman. And I think year to date, it was like 4.6 or something like that. Okay. Now, past performance doesn't indicate future results by any
Right.
stretch, and nor is it a guarantee. However, that's the fixed income, like safe portfolio. That's
It's
kind of
like
like
the
stable
safest
values.
portfolio. Yeah.
Right. And it's just made up of like short-term bond instruments and money market. It's real 4.6 though. And that's what I was saying to people. And that's liquid. You can call Bill and say, "Hey, Bill, I want my money out, or I need to take a
Yeah.
$10,000 withdrawal or whatever." And there you go. I mean, you're going
Yeah.
to have that money in your bank in a couple days.
Yeah.
That's what we're seeing now, and that's exciting because we can build these around safety, but also so we got our preservation piece, but we also have to have our growth piece. We have to have accumulation. I mean, you don't have to have accumulation, but I think the majority of
Right.
people do want some growth, right? That'd be
Right.
good, right? Now, some people are so nervous about markets, right? Where it's like Will Rogers, mattress might be a little lumpy, but at least he knows where that money is.
Right.
And that's a yeah, but that's a situation that a lot of people go through. especially growing up. You take my mom, for instance, South Omaha family, 9 kids. So you got 9, 10, 11. You got 11 kids feeding off of grandpa, who's a postal worker, basically, was a
Wow.
main career, right? You got 9 kids. Yeah, I bet things were stressful. I bet she
Oh, yeah.
saw and heard things that are like, oh my gosh, are we going to make it through? Right. And I think a
Right.
lot of families, not only back then, but even today with the way prices have gone up, can feel
Sure.
that same pinch.
Yep.
So if there's a way that we can kind of have the best of both worlds, right? Like without being greedy, and that's where people really start getting themselves in trouble, is when they're doing everything they can to kind of hit that home run.
Right.
And if you have a portion of your assets that you can play like that with, that's great, and it's not going to affect other things. But you shouldn't do it with all of it. And we've seen time after time people really lose their shirt trying it.
Right.
They're going into this. This is going to be the next big thing. This will be the next big thing. The new mineral that's coming out. Have you seen that new mineral? That's going to be the next big thing. Okay, maybe. Right. But are we really going to bet everything on it? That's scary.
Yeah.
I can't. I couldn't sleep at night doing it.
No.
But
No.
we do want to make more money than the lumpy mattress.
Yeah. Yeah. Or the low interest bearing account at a bank. You gotta, if you have a chunk of money, you can't just leave it in a checking or savings account either. And you
Right.
got to be careful with CDs. You need to make sure, depending on your time horizon and where you're at. And I know that's what I love about you and the team there. And, I've talked to Andrew about this and you about this in the past, Bill. It depends on your situation, where your money is going to go and what your time horizon is, and you'll be straight. And it's like you work with people with serious amounts of wealth,
Mhm.
millions and millions of dollars, and you work with people with not as much,
Mhm.
and you shoot straight with them. Here's what you should do in your situation, and if it's better, you know what, your money's fine in that CD. I
That's
mean,
right.
you're not going to try to force them a square peg in a round hole. You're going to look at where they're at and what their needs are as fiduciaries. You're going to do what's in their best interests. And I
Right.
like that a lot. And
Thank you. Yeah.
people need to know that, whether it's you or another financial advisor that's a fiduciary that you can trust. You've got to work with a financial advisor. You've got to work with a fiduciary who's going to look out for your best interests. And why not make it a place like Par Advisor, where, Premier Advisory Group, where everything's under one roof. You've got Medicare, you've got estate planning attorneys, you've got financial, tax. It's so
CPAs.
important. Yeah, CPAs.
Yeah, really, we want to make it easy for you. We want
Yeah,
to make your retirement streamlined, and so you can go off and right off into the sunset. And all you got to
right,
do is make that one call. Or if something happens and you're starting to get sick, or if you get sick someday, because everybody will, right? I think,
right,
and maybe
right,
not sick, maybe you just croak right away. I don't know. But don't you want kind of a backup plan? Who's Martha going to call? Who's Danielle going to call if something happens to Bill? Right.
right,
And
right,
that's it. Who's Sarah going to call if something happens to Tony, or vice versa? And those
right.
are the things that we tackle here and make sure that you're taken care of. Keep in mind too, folks, we go through a lot of this and kind of get really into the weeds more quite a bit at our events that we're having. We have 3 months of events coming up, 6 different nights. In September, it's the 23rd and the 25th. At 6 p.m. and we're out at Farmer Brown's. So we're going to talk about Social Security, interest rate outlooks, the One Big Beautiful Bill, the Secure Act 2.0 and RMD changes, long-term care, navigating market volatility. So we're really going to dive into it. Plus, you're going to have a great meal and nothing like breaking bread with my fellow Omahans or
Yeah,
Iowegians,
yeah,
Nebraskans, whatever
yeah,
we like it all.
yeah,
Um,
exactly.
so anyway, thank you so much, Tony. It looks like we're about out of time right now.
We are.
Okay. And so again, 402-557-6730 is our phone number, 557-6730, or go to bigomoney.com.
All right. Thanks, Bill. Listeners and viewers, thanks for tuning in. That does it for today's episode of the Big O Money Show with our host, Bill Altman.